what that means, and then we talked about property inspection waivers or for appraisals. Okay, so today we're going to build on that. We're going to go through a real skeleton overview of the loan process after you take a loan application. Okay, so issuing a loan estimate, timing the appraisal, and a CD. Okay, and what that is. And so today's going to be it's going to be a little bit more specific. If you were with me a couple sessions ago, we did a lot more screen sharing, and that's going to be more of what today is like. Okay. Y'all are so quiet today. Okay. Oh, my all right. So we've taken an application. We've had a conversation with the borrower. We've got some documents. We're going to run our automated underwriting system. Okay, so that's pretty much where we left off. We priced the loan to figure out what rate we need in order to run it in the underwriting system. So the next thing that we need to do is disclose, which is issuing the LE or the loan estimate. Now, if you've been in the business longer than 2015, or you were in the business pre-2015, then we're out of it and are coming back after 2015. This is the equivalent to the good faith estimate. Okay. Before the loan estimate, there weren't really measures around how you could disclose a good faith estimate. Okay, there really weren't any checks or balances for, is this being disclosed properly? How do I know that the fees, how does a borrower know that the fees that you're telling them might be associated with the loan are even valid? And there really weren't any checks or balances. And so a lot of what you hear about and part of the kind of bad rap that brokers got, or any loan officer for that matter. I mean, I still pick apart loan estimates when I see them when they're not disclosed properly, is that without checks and balances, I could tell you that these are going to be the fees for the loan and leave stuff out or under disclose it, and you wouldn't, as a consumer, you wouldn't know the difference. Okay, and so what would happen in the old days, and this is across the board, like this is not just broker specific, this is more like people not having good intentions, okay? And that can happen anywhere, right? Like that's not restricted to a channel of business. But what used to happen over here is a loan officer would disclose or a processor would disclose, and let's say they were competing, well, they'd underdisclose these fees, or they're manipulating the system and they would disclose the fees much lower than the actual fees for the loan they were getting. There was no wait period and there was no pre-closing review of this. So what would happen is consumers would get to the table and they would see this HUD statement. We used to call it a HUD, which is what a CD is now. Okay. They'd get to the closing table and look at the HUD statement, and they would go, and their cash to close or their cash back would be significantly different. And if you're at the closing table, what are you going to do? You're going to not close on the house? You got notice 3 hours before closing that you got to come up with an extra $1,500 or $2,000. What are you going to do? Are you not going to close on the house? And this was a big problem industry-wide, not just channel specific. So one of the rules that happened with the conversion to TRID in 2015 was that we got rid of the good faith estimate for most loans. There are some loans that still can issue a good faith estimate. But we got rid of good faith estimates and went to loan estimates and closing disclosures. Okay, so the reason that we're going to hit these three things today is because these have to happen at very specific times in order for a loan to close timely. Can everybody see my board okay? Okay. Okay, so couple things about loan estimates, and I'm going to step over here to this side of the board. So let me pretext this with, I am not a compliance person and I don't have all the rules memorized. I'm going to talk to you about best practices and general rules as we know them. Okay. Is my video going slow? Because the feedback on my side is really slow. It is.
Yeah, anytime there's video, Jacqueline, it like makes everything slow. That's why I turn off my video.
Monica, I can't hear you.
Oh.
Is it doing it a lot? It is. Okay, I'm gonna see if I can jump on our other Wi-Fi channel. Give me just a second. If it disconnects, then I will come right back on, but just sit tight for a second. So the camera needs to go to 2.4. That's probably part of the problem because it's supposed to be on the same channel as the Zoom call.
Switch this to stay on 5.
Oh, God. Okay. I'm on 5.
Okay, try that.
I think, okay. Okay. Is that better so far? Okay, we had the computer on one Wi-Fi channel and the camera on a different Wi-Fi channel. And so like every time I turned around, it was like, okay. Do you need me to re-go over anything at this point? We're good? Okay. Okay, perfect. Okay, so of course it was like cutting out as I was giving my disclaimer. So let me just give my disclaimer again, that I'm not a compliance expert. So I'm going to talk to you about the loan estimate in regards to the process of doing a loan and the important measures of getting a loan out. So some of this, just know that I'm not speaking to you necessarily from a compliance perspective, okay? One of the things, so I started in 2005 and I was fortunate enough, it's one thing that retail does very well is the type of training that they put on, right? Corporate companies often have a lot of time and money, not time, but money to do more training. I don't really know what that's like now, but 15 years ago when I got into this business, before I even hit the floor, which was basically the training I had before I was released into the sales floor, I had 3 weeks of 40 hours a week in training. And we had a really good trainer. Her name was Monica. And I remember the one thing that always stuck with me was this process of how to kill your competitor without killing your competitor. So how do you decredit your competitor without coming out and saying they're a POS and that loan estimate is bunk, right? Like, how do you do that? So one of the things back in the day when we issued good faith estimates, and I was working in a call center, so I was doing this over the phone, and I had never met a client, and one of the things that we were taught to do was ask them to send us their loan estimate. And a lot of bigger branches, retail places are notorious for not issuing a loan estimate within 3 days of having all 6 points of what a loan application is, and that is a RESPA violation. I think it's RESPA. Tilla, I'll look it up. I'll let you know. I don't remember. I knew that information to pass my NMLS test, and I don't really remember now. But it was once you have all 6 points of an application and you don't disclose, that is a violation of our regulatory compliance. So what would happen is I would talk to these clients and say, well, Mrs. Jones, I have all the information that by law I'm required to send this to you. So I'm going to go and send it to you. That's probably coming in the mail. Like, don't worry about it. I'm sure they sent it to you. It's not a big deal. Give me a call back when you get it. But I'm going to send you mine in email. And a day or two would go by and they would call me back and be like, well, I got yours like yesterday, but I still don't have the one from them. And I would just be like, ooh, man, like, I wonder if they realize the 3 days have passed yet, because like we're supposed to send those out, right? And so now I've discredited my competitor without saying like, they're supposed to do that, that's against the law, they're trying to screw you, don't even go with them, right? Like, I'm not having to badmouth them at all. I'm just talking about my performance inside of law and compliance, right? And really, that's also minding my own business and staying in my lane. I mean, I want the best for you. And so now they know that I've got their best interest at heart. So for a loan estimate, once you have all the 6 pieces, it has to be disclosed. So you have to issue a loan estimate. And it's broken out in buckets, okay? So this is where all your origination fees are going to be in bucket A. And this is where the majority of your QM compliance fees are going to be calculated from. There's a couple that aren't in this box, like appraisal. But this is going to be mostly where your QM is. Okay, so on A3, when we talked about compensation, in order to be a loan that's securitized or backed by Fannie Mae or Freddie Mac, it has to meet QM. It has to be a qualifying mortgage. That stick of measure is the fees have to be under 3%. This is why everybody's compensation is 2.75 or lower. Because you can't have any fees more than 3% of your loan amount. And this is 2.75 because you have some other fees that get calculated in there, like appraisal, underwriting fee, okay? Box B has a 10% tolerance, meaning that what I initially disclose on that very first loan estimate, is your video jumping around the way it is on my side? No, okay, good. Okay, if my initial loan estimate is if my final CD is 10% more than what I disclosed on my initial loan estimate, I have a tolerance cure. And depending on what fees it is and what bucket it's in, I'm gonna have to pay penny for penny on the difference that I underdisclosed. Okay? Now, I don't always know how much an appraisal is going to cost. I don't know what AMC I'm using. I don't know, like in Colorado, Weld County, when they came out with the new appraisal requirement, appraisal renewals dropped, like appraisers renewing their license, dropped by 35%. So now the appraisers that are left can charge a premium, but I don't know how much it's going to be, right? So what happens if you disclose something and then you find out that it's like more? So we just had this on one of our files, and we hit a tolerance cure because it was in one of these buckets and it was over 10% of the total that we disclosed. But if you find out something that you need on a file, you've got to request a COC or CIC. They all call it different. There's a proper name. I'm not going to go argue with all the banks about how they label it. It's a change in circumstance or a change of circumstance. Oh, that's right on my ring. CIC or COC. So, and you only have 3 days to request that change. If you don't request that change within the 3 days that you know it, you don't get to update your loan estimate and you're going to be hit with a tolerance cure. So, as a best practice, I'm going to give you a couple tools, but as a best practice, I always over disclose, and I tell my clients, well, let me not jump ahead. I'll tell you what I tell them in just a minute. Okay, your loan estimate is your client's first opportunity to see what this loan transaction is going to look like. How much money am I going to need? What's being collected? How much am I being charged? Okay. And that's what I tell people. You're going to have two types of clients. You're going to have the client who doesn't read anything and they just sign everything because they're auditory and it's really overwhelming for them to review all this stuff. So they're going to sign it and then they're going to call you and want to talk about it. Okay. So I'm going to do a couple of things with you guys. We're going to do both. We're going to look at it and we're going to talk about it. And then you have the client that wants to read through everything and they want to look at everything and read over everything. So when we issue an initial loan estimate, what I tell my borrowers is this is your first opportunity to begin to see what the numbers are going to look like. What happens is you will probably receive 2 more of these because as we provide information to the underwriter and they update it in the system, some banks automatically, like UWM, will automatically send a new loan estimate anytime something is changed. Okay, other systems you have to request the loan estimate or when you lock the loan, a new loan estimate will go out. So this information could change if you're not issuing a loan estimate with an interest rate that's locked at the time you submit. Okay, so I always let the client know. And you'll have clients who are like, I don't want to sign this until I know what my final numbers are. And I let them know what you are signing. This initial loan estimate and disclosure package does 2 things. Number 1, by law, I'm required to send this to you within 3 days. So one thing that your signature does is acknowledges that I have sent to you within 3 days of having all the information that you have received this documentation. You are saying, yes, I have received these things, okay? The second thing is I need you to go through and review section 1 of the loan application. We talked about that the other day, right? Please make sure your name is spelled properly, your social's right, your date of birth. Make sure I haven't typoed any of that. And then I also let them know, I explain this to them. I say, listen, by law, there are a number of these fees that I have to be within 10% of whatever the final cost is going to be. And if I don't, there are some of them that I have to pay the difference penny for penny. And I don't like doing that. So because I've been doing this for a while, or I'm going to pull an estimate, or I pulled an estimate, which I will show you how to do. These are a little bit high because I don't know what they are yet. And we haven't gotten that information back from title, but I don't want to under disclose. And then I tell people, I say, listen, if I tell you you need more money than you need, you're going to be real happy with me. But if I tell you you need less money than what you need, you're not going to be very happy with me. So I'd rather pad this on the beginning and start getting you prepared, because it's possible that this is what it could be. But I would rather shoot high and come in low, but I need you to start seeing this for the first time, okay? And Isabel can attest this, that's almost verbatim what I tell my clients. And then they feel comfortable signing it because I tell them, we're gonna put today your title order request is going to go in. It usually takes title 24 to 48 hours to come back to us. When it comes back to us, depending on what bank we're in, we either can manually update that or we have to put a request in to update that data. But just know that 3 days before closing, you're going to get a closing disclosure that's going to have a lot of these numbers updated. Okay, it might not quite be your final numbers. It depends on the bank that we use. Some of them work with title to issue this to you and some of them don't. Okay, but we'll have a better idea what your closing costs are going to be when we get down here. And I let them know, I reassure them that they're going to see this more than once before they close. Okay, and that's how I overcome that initial objection on those initial disclosures of people who don't want to sign them. First of all, I'm saying, hey, you're acknowledging that I abided by the law and sent these to you. Okay. Now, another important thing, this has tripped me up. The first time it tripped me up, I didn't understand it. So the second time it came around, I was like, oh no, I've seen this ugly zip before. We're not going here. I'm gonna figure out what's causing this. And now I want to share it with you all. I'm sorry. Is everybody okay if I erase this? Good? Okay. Now, there are some banks, and if you have a really high credit qualifying client, where you can get through this stuff, where you can get through a loan really quick, especially if you don't have to do an appraisal or like on a refi. I've gotten a purchase clear to close in about 6 days because we ordered a rush on an appraisal. Is my camera still bugging out? A little bit?
Just a video.
I don't know. I got kicked out and I had to come back in.
Yeah, I think we need to get off the 5.0 and go to the 2.4.
Your audio is.
I can't hear you.
Your audio is fine. So if you're lagging, we can still see and like hear what you're saying. So
Say that again.
I said your video may be lagging, but your audio is good. So your words are real time. So it's not like it's chopping in and out your words. So I can still understand. I'm not going to speak for everyone, but the video isn't the most important thing as long as I can hear what you're saying.
Okay.
Video comes in and out, and then I can piece together what you're writing with.
Okay, then we'll just continue. Okay, so.
Lisa said, Lisa Willis said that the audio is choppy for her. So I just she said that in the chat. Just want to make that clear.
Okay, let me do this really quick. Just hold tight. We're gonna switch to a different Wi-Fi network. Give me 1 second. Oh no, okay. All right, let's try this network and see if this one works any better. Can you also just go over there and make sure like all of our antennas and everything are with the router and stuff? Okay. Okay. I still feel like it's lagging on my side. It is. No, I don't think it has anything to do with y'all's videos. Give me just a second. I'm gonna close out some stuff I have on my computer just to make sure it's not me running too much stuff. So give me just a minute. Okay. Oh, so much to tell you guys today. I don't like this at all. Get it to reset. I feel like the 2.4 is worse. Sorry, and I want to go back to the 5. Can you just reset that to 5, please? Yeah, like now 5 only has 1 bar. Okay, we're just gonna go back to this one. You guys, I'm so sorry. You'll just have to bear with me. Would it be helpful? I mean, I don't know. I don't think it has anything to do with your cameras. If you want to try, I don't think so. I think already it's doing a little bit better. So, and I turned off some stuff on my computer. Okay. So back to loan estimate. So a couple things about loan estimate. There was something that I learned. Really, it hit me in the last year because until you close a loan really quick, you're really not going to need to know this. But we need to talk about the consummation rule. And the reason I want you to know this, 2 things is, you know, when we come out the other side of this, we're expecting to have a big refi boom. I don't know what's going to happen with properties and whether Fannie and Freddie, like right now, right? Fannie and Freddie updated to give more appraisal waivers the last couple of weeks, and then I think they're going to take that away. But that may come back. And so when you don't have to do an appraisal, or you do an appraisal on a rush, or you get a transferred appraisal, let's say you're saving a deal from another lender, you can turn a loan really quick. So I've gotten, I think my fastest clear to close is 4 days. I know that there are some weirdos out there that have like 1 and 2 day, but they're weirdos and they use UWM and it's like really an anomaly. Okay, so the 7-day consummation rule is from the day you issue, you cannot close this loan until 7 business days have passed. But this is not your traditional business day. This is 7 business days that the bank is open. So most banks, unless they're a depository, or most wholesale lenders, do not operate on Saturdays as a standard day of business. So for this particular rule, Saturdays don't count. Okay, so if I issue a loan estimate on Tuesday, and I've got it submitted, I get the loan out on Wednesday, I resubmit for conditions, and let's say I get my clear to close on Friday, okay? And that is no stretch of the imagination with working with UWM. And even Remen when we're not in like COVID times, okay? But 2 things have to happen before I can close, right? We have to issue a CD, a closing disclosure. But technically, if I have my ish together or I have a really good processor, when this thing comes out on Wednesday, and I had all the documents in there to be able to issue a CD, I could have issued the CD on Wednesday. So Wednesday, Thursday, Friday. If it's a refi, technically I could sign on Saturday. On a purchase, I could sign on Monday. Okay? Is everybody following me here? Okay, so we submit, so we apply, run our disclosure, or run our underwriting, we disclose, we issue the loan estimate on Tuesday, it goes into underwriting, we get our conditions out on Wednesday. We don't have very many, we resubmit on Wednesday, underwriter reviews it on Friday, I'm clear to close. Let's say on Wednesday we issue the CD. CD has to go out 72 hours, which I know I'm jumping a little bit ahead, but just stay with me, 72 hours before closing. So if the CD is issued Wednesday, so we have Wednesday, Thursday, Friday. If it's a refi, we can sign on Saturday, that's fine. Or Monday if it's a purchase. Except we have this 7-day consummation rule. So if we didn't have that rule, we could do this. But with the 7-day consummation rule, let's say all of this is still true. Okay. For the CD, the earliest day for a refi I can close is Saturday, and for a purchase is Monday. With the consummation rule though, I have Tuesday, Wednesday, Thursday, Friday. The bank's not open Saturday, the bank's not open Sunday. So we have 1, 2, 3, 4. Monday, Tuesday, Wednesday, Thursday is the first day I can close. 4, 5, 6, 7. And I have a feeling that this is going to be something that starts popping up more and more Q3, Q4. As we come out of this and people are buying houses, and we're going to see this happen more. Okay. So I don't expect you to remember this. I don't expect you to like, know it right off the bat, but I will tell you that when you hear this now, you will know what's being said to you. And I literally didn't come across this until the first time until 2019. So for 12 years, I guess TRID's only been in effect since October 2015. So it took me an entire year and a half of being in TRID before I ever even heard this or knew what it was about. Okay. Can I erase this? Anybody need it? Okay, good. Okay, we're going to jump into a little bit of screen share. Okay, some of your lenders are going to want you to upload a fee sheet or a title estimate in order for them to send out your disclosures. Okay, so my preferred title person works at First Integrity Title. I just Google, I go to their rate calendar. We're just gonna do, so if you were with me the other day, we did a loan for Jamie Jones. He's a cook at a taco shop. I changed his name from Jane to Jamie because he was getting made fun of a lot. He was getting bullied. So it's Jamie Jaime, okay? So it was a purchase that we were working on. So it's a residential sale. Property address is 123 Main Street. It was Jefferson County in Littleton. The property type, we just said it was a single family. Now, I'm just gonna hit on this one more time. So single family, 1 to 4 units. Really what this is asking is how many single family units is this loan covering? So if somebody is buying 1 unit of a duplex, it's still 1. If they're buying the whole duplex, then it's 2 units because the loan is covering each house, okay? Same with a condo. If there's 100 condos in a unit and we're only financing the one that the borrower is living in or going to live in, then it's a 1 unit. Okay, is there a real estate broker involved? Yes, there is. Our sales price on this was $280,000. Jamie sold a condo, so he had some money to put down, and so his loan amount was going to be $250,000. I don't know. We're not going to do any qualifying discounts. You might have this if you're refinancing somebody within the first year and you did their home purchase. You might want to put this in. A lot of title companies offer a discount for a new title policy issuance within the first year, and then they offer a little bit less discount for a subsequent title policy within the next 2 to 3 years. Is the property a foreclosure or short sale? No. Who will be paying the owner's title policy? This is going to be state specific. In Colorado, the seller pays it unless it's agreed upon in the contract that it's going to be paid a different way. And normally, and this again is going to be state by state, but in Colorado, the real estate closing, so signing the real estate closing documents, the warranty deed, and the transfer paperwork is split 50-50. Okay, so we're just going to calculate the cost. Okay, so my title insurance policy is $1,400. And my owner's extended coverage is $75. I don't often disclose this, but what I've found is in more times than not for extended coverage, that expense is passed on to the buyer. Their closing fee is $160 for the residential sale, and then $350 for their closing fee, for their mortgage documents closing fee. For a total of $1,920. They have an estimated recording cost. This is what the county's going to charge to record the documents. And then the state of Colorado has a transfer tax. It's what they charge to tax for the transfer of ownership of real property. It's 1/100 of 1%. It's like a penny for every $100 or something like that. Okay, now a title insurance policy, if you don't, oh look, here we can go here. So a title insurance policy, and the way that I explain it to my clients is it's a policy, it's an insurance policy that protects the bank. That way, if anything happens with the closing of the documents or an erroneous error that makes the loan unsellable on the secondary market, the lender can make a claim on the insurance policy because the buyer is the one taking out the loan or the borrower is the one taking out the loan. They pay for that insurance policy. Okay, that's a real high level overview that you can explain to your client. What is this $1,000 fee that I have? Okay, and most of the time it's a grid. It's how much are they financing? What county are they in? Ba-ding, that's how much you're gonna be charged. Okay. Well, I don't like this. I don't like there we go. We're just gonna stay in the buyer screen. Okay, so how do I disclose this? All right, so I'm in Calyx. I'm gonna go to the fee sheet in Calyx. Well, I'm gonna think about going to the fee sheet in Calyx. Okay, so today's the date we're
You
preparing.
have a question in chat.
Yeah. Oh, I do? I can't see the chat, so if somebody can monitor the chat because we're in screen share, I can't see the chat. What is the question, Isabel?
The question is that different than mortgage insurance, what you're talking about?
Yes. Yes, yes, yes. Great question. Okay. I'm going to stop sharing really quick. There's so much insurance in lending because it's so risky. Okay, so what this person is asking is this different from mortgage insurance? Okay. Mortgage insurance is an insurance policy that the borrower pays basically in the event of default. And what we talked about before and the way that I explain this to people, mortgage insurance, you're going to see this as a monthly amount on their payment. On FHA, this is also the 1.75%. And on VA, it's whatever their, oh y'all, today's going to be like this. Funding fee, jeez. Okay, these are all monies that are for this reason. Mortgage insurance is a policy basically with the thought behind the event of default of the borrower. So the way that I explain this to my client is mortgage insurance. Most people have bought a car and most people have financed a car. And so what I tell them is, you know, like when you buy a car and you have a loan, the bank requires that you carry full coverage insurance. That way, if the car is totaled, because everybody knows that as soon as you drive it off the lot, it's not worth what it was that you just paid for it 5 minutes ago. If you were to get into an accident and the car is totaled, the bank wants to have their money back because you're not going to make a payment on a car that's totaled. Okay. So that's why when you finance a vehicle, you're required to carry full coverage vehicle insurance. That way, if the loan or if the vehicle is totaled, the full coverage pays the loan off. Okay. Well, that's the same thing for mortgage. But what is the stick of measure, right? Because you're not going to pay mortgage for 30 years. It's when you have 20% equity. And the closer to 20% equity, the lower the mortgage insurance is going to be on a file, except for an FHA. Now, VA doesn't have a monthly mortgage insurance. They just have their funding fee. Okay, FHA has the 1.75 premium up front, which is usually, 99.999% of the time added to the mortgage loan. and it has a monthly mortgage insurance. And the only time there's like a couple of instances when you don't pay that, but on FHA, this is for the life of the loan, because the parameters under which an approval can be issued for an FHA loan are so high that the risk of default is even higher. So that is why. Now this insurance, what we're talking about is title insurance. This is more like if something is done on the title work or somebody comes back and so for example, we bought a property in 2017. And so real life story, we bought a property in 2017. It was about 4 acres. It was 2 lots. When the subdivision was originally built, it was a cul-de-sac because at the time, fire law required all neighborhoods had to have an entrance and an exit that a fire truck could get in and out of. Well, it was before cul-de-sacs were kind of created, right? So all the neighborhoods were horseshoes. So a fire truck in theory could get in this side and get out that side. Well, the property that we bought, the roadway was right in between the 2 lots. Well, the neighbor behind us bought his 2 lots and built a shed on the lot that sat over the roadway. And so now this lot was landlocked. There was no access to it, which basically made it non-buildable. So that neighbor went to the county and said, I want to merge my lots and I want you, the city, to vacate this roadway that you're no longer going to build on because the fire truck ordinance has changed and a fire truck can get in and go in the cul-de-sac and turn around and go out of this neighborhood. So 20-ish years before we bought this property, the county had vacated this roadway and said that this entire property was now one legal description. The owner at the time went to an attorney, and well, I guess not at the time. Several years later, the owner went to an attorney and had a beneficiary deed created for his daughter so that upon his passing, the property would go to his daughter. And this was like several years after the road was wiped out by the county and they said, okay, we're not going to build on the road. This is all one property. And it was deed restricted, meaning you can't build anything on the other side of this lot. And so what happened is when we bought the property, it was sold to us as 2 legal lots. So when I went to inquire about building on lot 2, all the neighbors lost their ever-loving elderly minds and were like, you can't do that. And I was like, mind your own business. I do whatever I want. I don't like being told what to do. And then I was like, oh shit, what if I'm wrong? I don't like being wrong either. So I started investigating this, and sure enough, even the county had been charging taxes on this lot as a residence and this lot as vacant land. And I got educated real quick in a lot of things about zoning and property taxes. This lot that was vacant land was being charged tax at 29% of the value. The tax on this lot alone was $7,000. And the sellers that had owned this property that sold it to us had paid for years. Like, look, I'm telling you, it was like 20 years, had paid $10,000 a year on property taxes on this lot that the county had said 20 years before no longer exists as vacant land. It's a part of this residence, and for 20 years should have been taxed at 7%. So I went back to the title company and I said, hold on a minute. I was sold this property as 2 legal descriptions. It's your responsibility as the title company to follow the chain of legal and ownership. And back in 1990, whatever, the county said, this roadway is not going to be built on, and this is all one legal description. I had spent over $500,000 on a property that wasn't sold to me in the way that I expected it to be sold to me. I thought I was buying 2 lots because that's the way it was sold to me. So I placed a claim on the owner's title insurance. Okay, the seller has to pay for that. in most states, if the seller picks the title company, they have to pay for that insurance policy. This protects me as a buyer, that if any claims come out of anything related to the property and title work, I now have the policy insurance available to me to protect myself. So we ended up having to get an attorney, and it was a big deal, but okay. Now, let's say that the title company had the wrong legal description and didn't record an easement. So an easement is like, let's say you have like public utilities that run underneath a portion of your land, and there's an easement which gives the city and county or utility commissions access to your property without your permission because it's for the good of the utility and they get to do whatever they want because they're the government, right? But let's say something about that recording made the loan defunct. Like it was an issue, it's in litigation, the lender can't sell it on the secondary market because whatever this issue is that happened at title, right? The bank can now make a claim against this policy and say, hey, you screwed up our title work and our closing on this, and now we've got to keep this loan that we would otherwise sell to an investor because you botched the title insurance. That's why I pay for it as a borrower, because I'm the one borrowing the money, because I didn't have all the cash to pay for the house. And so that's why I pay for that policy. So does that help explain the difference between all of these different kinds of insurance? Okay, great. If it doesn't, no worries. As you get more experience and you come across these things, you'll remember that we talked about this and that there's a difference. Okay, so back to screen share. Okay, so on our estimate here, I don't want to see both. Okay, so we have, we have closing services. Now, I normally break the closing protection letter cost out. You don't have to, because this goes into bucket B, and so it's all based on that 10%. But let's do it like this. So I'm going to go into Calyx. I'm going to scroll down to services you cannot shop for. Sorry, services you can shop for. And you can shop for them. It's just that you signed a contract that said that the seller was going to pick it. Okay, it doesn't mean just because the seller picked it, you can't shop for it. That's just the terms of the agreement that was on the purchase contract. But otherwise, the buyer could shop around for these services if they elected. They could say, I don't want to use the seller's title company. I want to use my own. And the seller's like, that's fine, but then I'm not paying the fees for some of these. So anyway, so our closing fee is the $160 for the real estate and the $350 for the loan. So that's $510, $450, $510. So we're gonna put $510, whoops. Now, I've been doing this for over a decade. So I don't specifically do this part anymore. I don't specifically go and look it up. I pretty much at this point kind of know what these fees are gonna be. But I want to show you guys how to get knowledgeable to where you can get to the point where you can just go and punch them in. Okay. Why does this look different than what we were looking at before? Didn't it say that it was like $1,400 a second ago when we were looking at this? Let me just rewind here. Sorry, you guys. Oh, of course you are. Let's go forward. Let's go back. Okay. There we go. $1,461. Okay, so lender's title insurance, $1,461. Okay. if you have any, like if you're in an attorney state, like Texas is an attorney state, we typically put 150 to 200 bucks in here. The recording fee, so the county's gonna charge for you to record the mortgage note and the deed. I typically just disclose this as one. Some people break it up into both. So they might say like 150 and 40. It's okay. This is going to be one of those ones that's in the 10% bucket. Okay, so it doesn't matter if this ends up being 170 and this ends up being 20. It's going to take the bucket as a whole. And then the owner's extended coverage. We don't actually have like a separate bucket for that. But what I'll do is I'll go up to here and I'll just put, it's abbreviated as OEC, owner's extended coverage, and I'll put that 75 bucks in there, okay? Now the other thing is the appraisal. I always disclose like 670, ooh, not 6,700. I always disclose 675. My credit report fee, when you pull credit, Advantage Credit will put the invoice on the last page. You should have a good idea of what you're going to charge, what the charge is. I usually list $40 for an individual and $80 for a married couple. 9 times out of 10, it's far less than that.
We have a question.
Yes.
Is there a list of all the fees for a new processor? How do I make sure I do not miss one?
So the best thing you can do if you're a new processor is use the lender's smart fee sheet until you get more comfortable with this. And there is, but I can't blanket statement that because every state does things different. So like Colorado is not an attorney state. We don't close with attorneys. We close with title companies. Some states actually have a title company and an escrow company. So how you would disclose that and the list that you need, my initial suggestion would be to get so a couple of things that you could do would be if you have access to UWM, I would just go in, generate smart fees. When you disclose to the borrower, grab that loan estimate out and look at it. Look at it. See what fees are populating in there. And I will tell you that like every new state that I got licensed in, that's what I did. I did the smart fees. Like I just got licensed in Texas in 2019. I would do the smart fees and then look at what was on the smart fee sheet. Okay. And you'll get to know what these are. State recording fees, like this one, this is that one penny for 100 of 1%. This is a penny for penny, but in counties in Colorado that are considered the Front Range, it's nominal. Like it's pretty much always going to be less than 100 bucks. But if you're up in like the mountains, this transfer tax is calculated completely different and can be thousands of dollars. And it doesn't matter whether it's $50 or $10,000. This is a tolerance that's penny for penny. Okay, so as much as I want to help you guys out, I'm not a compliance person. So I'm not going to go out on a limb and kind of speak to that. You will have to do a little bit of research. The best thing to do is go back and look at some other loan estimates or call your account executive. Ask them to walk you through in their system what is the best practice for them. And it might be that you use their smart fees in their system. And here's the other thing. If you use smart fees in their system and it's under disclosed, they're going to eat the tolerance cure. Most times. I think UWM still passes that buck on to us. Prepaid interest is going to be the days from your closing date until the end of the month. So if you're closing on the 15th and the month has 30 days, that's going to be 15 days. If you're not sure and it's a refinance, I always disclose 20 days. Insurance, you always are going to collect a full year's premium. Let's just say the full premium was $1,000. Oh, hello, hold on. 100. So the full year's premium was $1,200. We're going to collect that up front to start their insurance policy. And then as they make their mortgage every month throughout the year, it's going to put 1/12 of the insurance money into their escrow account. So next year when the policy renews, there's enough money in the escrow account to make sure that the bank can pay their insurance policy. Sorry, let me do that here. 12 months insurance. And then you have what's called prepaids. And this is their money that we're going to collect at closing on their behalf for their stuff. Let's say their property taxes are also $100 a month, okay? Okay, so I'm not gonna go over all of it, okay? But now like for this specific transaction, Jamie's gonna need to bring $4,900 to closing. Okay. Now I'm gonna print this out really quick so you guys can see a loan estimate. There's a fee worksheet and a loan estimate. Now, the other thing I will tell you that as a loan officer or a processor, I always name my document what it is first and then who it belongs to. Because if I just put Wells Fargo bank statement and I'm looking for a bank statement and I have 50 documents in a file, I'm not going to find it right away. So figure out what your terminology is going to be if you're going to call it asset or bank statement. So I always do the name of the document, the name of the borrower, or the name of the document, the date, and then the name of the borrower. So like if you have two borrowers on a file and they have a W-2, so it'd be W-2 19 Jimmy, right? And then W-2 18 Jimmy. So that I knew it was Jimmy's W-2, and then maybe his wife Kathy has two as well. Okay. So this is the fee sheet. This is all the fees that we've put in. We're not charging, right? This is lender paid, so we're getting paid by the bank. There's no charge here. There was no charge for the rate either. We actually price the underwriting fee into the rate, which we kind of talked about the other day. If you didn't get a chance to watch that, no worries. And so here's all the fees that we just put in, right? Now in a loan estimate, was there a question in the chat? Something just bleeped at me.
Someone just said that they can't see the document.
On the screen share. Can everybody else see it?
No, we're still on Calyx, it looks like.
Oh, hold on. There we go. Good?
There we go. Now it's up.
Okay, good. Thank you. Okay, so not a lot of people print a fee sheet anymore. I still do, because depending on what reads easier to the client, sometimes this reads easier to the client, but it's all the same information. This is just a fee sheet, bottom line $49.29. This is a loan estimate. Okay, bottom line $49.29. The meat and potatoes that you want to go over with the client is page 2. Okay, so in simplest best practice terms, I call box A origination. Oh, sorry, box A is origination. I call this the price tag. Okay, what are they paying? What is the cost for the rate, for the loan, for the process? Okay. Box B is services you cannot shop for. You cannot pick the appraiser. The borrower cannot pick the appraiser, and the borrower cannot pick the title company. And then box C, services the borrowers can shop for. Now, when we're talking about compliance, and what I want you to know is this is the reference in compliance that you're going to be able to figure out what is the tolerance measure for each. We call it a bucket. Okay, so this is bucket A. We talked about in a couple classes before APR, right? The APR, the annual percentage rate, is the cost of the loan annualized over a year or over the life of the loan. So if a consumer has two loan estimates, one from you and one from another lender, and all of this information looks different, how do I really know as a consumer what deal is what? Which one's the apple, which one's the orange? Or are they two apples and one's a red apple and one's a green apple? I personally like red apples more than green apples, so I'm gonna want the loan that's the red apple, right? Well, the apples to apples comparison is the APR, right? And so the APR is gonna be derived the majority off of box A. Okay, also for a tolerance measure, if you make changes to box A and your APR moves more than 0.125 or an eighth, after you've issued the closing disclosure, you have to reissue and restart your 72-hour wait period. And it took me a long time, and I did a lot of this by myself in the dark, figuring that out. Okay, box B, services you cannot shop for. This is a lot of like compliance, has to be organic, can't have any touches on it. And then services you can shop for. This is your 10% bucket. This is where you can be off by 10% and still be good. Okay. And then this is where you would see your APR. We don't have all the information in here for it to generate an APR, but you would always find the APR on page 3. Any high-level overview questions on this before we kind of move into the next part? Good? Okay. All right. Okay, so taking the application, run underwriting, AUS, we've disclosed the loan, we put the fees in, or we did the smart fees for the loan estimate. This is why your account executive needs to be worth their weight in gold. They should be able to walk you through this. And if you've got an account executive that doesn't know how to walk you through this or doesn't have the time to walk you through this, you got an issue. And you're going to spend a lot of time figuring this out by yourself. Okay, so we've done the loan estimate, we've disclosed the loan. Okay, the borrower is signed. And depending on how your handoff goes with your processor, you're either going to send it off to your processor then, or you sent it off to your processor here to disclose, right? And it's in underwriting, okay? So the minute that it goes to underwriting, or the minute that you're submitted, you want to get this appraisal order. Okay? Because these things can take 7 to 14 days, depending on what season you're in. Last summer, we had appraisals taking 21 days. If we wanted it in 10 days, we were paying $200 in rush fees. Okay, our appraisals were costing us anywhere between $850 and $1,100 during the summertime, because Colorado was the #1 housing market in the nation for like 30 months. And the only way to get prioritized was to pay more money, okay? So you want to get the appraisal ordered and get in line. And what I tell my clients is, I tell them a couple things. We want to get in line for the appraisal, so we're going to go ahead and order it. A lot of times they get really concerned about spending the money before, especially in a purchase, before they've gone through the inspection. And I tell them, we're securing our spot in line. If you don't get through appraisal inspect, or you don't get through property inspection, that's okay. We'll cancel the appraisal. No harm, no foul. Most appraisal companies won't charge the appraisal until it's assigned with an inspection date. Some of them don't charge the appraisal until the inspection occurs. But as long as the appraiser hasn't even gone out to the property, you can cancel it with no charge to the borrower, even if it means they have to get it refunded back. If the appraiser goes out to the property and does the inspection but hasn't submitted the report back in yet, you can still cancel, and they'll typically charge you a trip charge. I've seen it anywhere between $75 and $150. Okay? And if the appraiser goes out, let's say the appraiser goes out, comes back in, appraisal is low, everybody decides to terminate because they can't come to an agreement on what to do now that the appraisal is lower than what they agreed to sell and buy it for, there's no refund there, okay? But you want to get in line for this right away while you're still waiting for underwriting. What you're trying to do is get this CD or the closing disclosure issued. And you really want to try and get all your bullet points to get this disclosure issued well before 3 days before closing. When this process was instituted, it basically cut loan processing times down to 21 days. Okay, so a closing disclosure is basically the reissuing of a loan estimate with all the updated figures, or as many updated figures, right? We just got the title quote, but that may not be your actual title fees. You, as a loan originator, if you're self-processing, or your processor is going to send the request out for title. We did get that quote online, but title's actually going to send back what the real numbers are, okay? And so those numbers should have been, well, in some systems, the lender will update it. In some systems, you or the processor have to update it. And we're trying to get this CD out because you can't close for 72 hours until this is issued. So if I issue on Monday, the soonest I can close is Thursday.
So talking about the COC or CIC and the 10%, this CD that's going to be issued after the appraisal and all these other numbers are coming in, that's when we want to be within the 10%. When we get the right numbers from title and everything, that's when you're saying you're going to pad it, so that way, you know, if there's more money, they're bringing more money, they're going to be happier instead of less money. This CD going out 72 hours to close, that's when we want to be within that 10%.
It is, and every lender does this, every bank does this a little bit different, okay? Some will let you self-generate this and you can go in. So some systems allow us to update the figures and issue this ourselves. Okay, so we want to get the, we call it a preliminary CD or a preliminary fee sheet from title. We can update it and then we can send this out. Other lenders say we want the fee sheet from the title company uploaded to the portal, and then they work with title before they send it out. Some of them, as long as you have certain bullet points, which I'm going to tell you here in just a second, as long as you have the certain bullet points cleared, they'll just send it out. So your job is to know, or your processor's job is to know, how does that bank handle the CD process? And so what I tell my clients, depending on the process, is, hey, this is the final numbers that we have so far. I want you to go ahead and look at it. Please sign that you've received this. I'm then going to send it to title. I'm not trying to trick them, but I am wanting them to think that the process doesn't go on unless they don't sign it, right? But I let them know once they've signed it, I will send it to title for them to make any changes. And then we'll get it back. But this should be pretty updated, okay? By the time that you're issuing it to the borrower. You might be off like $300, $400, $500, but you shouldn't be off $1,000. You shouldn't be off $2,000. You know, you might be off because your escrows, like I don't calculate escrows. I don't know how to do the the adjustment that they do for escrows, that's all like funny money to me. I don't, you know, and I tell people that like they do adjustments and per diems, and that's just not a part of the transaction I'm a part of. Title does that, and then they tell us what it needs to be. Okay.
So when we send that to the client, and how you said for them to sign it, to send it to title, and they'll make adjustments, how would you, I guess, explain that to them so that way, you know, like this is close to the final numbers. It could be sway $200-300, but this is, you know, a 0.1% or a percentage of, you know, expect 2%, or, you know what I mean? Like what I'm trying to say, like if that's close to, you know, I'm just guessing, like how would I word that to the client for them to understand?
Yeah. I would just let them know they're not their final numbers yet, but this is going to be the format that they're going to see at closing. And we're going to make some changes. I don't yet know how much that's going to be, but I can see like the insurance has been updated, you know, things like that. So I don't give them a dollar amount or a percentage. I just let them know that this is the preliminary CD. It's their first initial look at the closing numbers. If I know that it hasn't been sent to title to review and balance, then I tell them, hey, we've still got another step here before we actually have your final numbers. So I need you to just sign that you've received this, and I'm going to ask title to go ahead and start working on numbers for your transaction. And when that's updated, I'll let you know. I'll give you the updated sheet. Okay, does that make sense? But I don't commit to a number, and I don't commit to a percent, because some, like I just said, some of that is funny money, and I don't know how it's calculated. Okay. Now, what are the things that you need to have in order to issue a CD? Okay. So you have to have the loan locked. You have to have the loan locked. So, you know, it's the program, like what kind of loan, the rate, and the term. And the term is how long? Is it a 30-year, 20-year, 15-year? Okay, so you have to have the rate, you have to have the loan locked. The loan has to be initially approved. It's got to be a viable loan. It's okay. This has changed a lot. When TRID first came out, some lenders wouldn't issue a closing disclosure until the file was clear to close. It was such a pain in the ass. Okay, now you can issue what's called an early CD as long as you have these bullet points completed, even if the loan isn't clear to close. You have to have the insurance amount or premium. You have to have the property tax. And that's going to come from title or escrow. And you have to have the appraisal in. You have to know the value of the home, right? Because the value of the home and the loan amount is the loan to value, which determines the rate. So you have to have the appraisal in. So now what you see is these are your motivating factors. If you are working with a borrower as a loan officer, I will tell you right now, this is the thing that holds up a CD, this and this, insurance and appraisals. That looks like inappropriate. Okay. These are the two items that will hold up getting a CD. Okay. So that's why I'm saying to you, order your appraisal as soon as your file is submitted for underwriting. Get in line for this thing. Okay, an insurance premium as a loan officer, when you're taking the loan application, when you send this first set of initial disclosures, your conversation with them should be something like, hey, I'm sending you your initial disclosures. A couple of things here. Number one, by law, I have to send them to you within 3 days of having all the pertinent information. So I want you to go ahead and sign and acknowledge that you've received these. You're going to see this same packet again at closing. Between now and closing, the underwriter and myself are just going to be updating the data, and at closing, you're going to sign the final updated package. All the information is going to be updated as it's verified. Okay. The other thing, Mr. Customer, that I need from you today when you sign this back to me is I need to know who you want to use as insurance. Now, we do a couple of things at my brokerage. We always encourage, so Colorado is a state, and I don't know about other states, I can only talk about like Colorado, New Mexico, and Texas, but we have a specific law that says that the borrower has the right to choose their own insurance provider. So like, I can't just go and get it for them. Colorado also has a law, because it's an when you bind an insurance policy, you're incurring a debt. Okay. If a policy is bound, there is a bill that is paid. And so I can't just go and get an insurance policy for somebody because now they're bound to pay it. So insurance law requires that the borrower sign an application knowing that they're about to incur this debt. Okay. So what I always encourage my clients to do is whoever they're getting their car insurance from, call your company and ask them to quote you insurance. We also work with 1 or 2 local insurance brokers. They do what we do, but they do it for insurance, and we will ask them to quote it for the borrower. Okay, we'll give them the parameters. We've got a little system set up, but we'll send that out right away at the same time that we send out our request for title work. Because what you're trying to do is when you get this underwriting approval back, you're trying to have all this other stuff, as much of this other stuff come together at the same time that you get this back so that you're ready to submit for conditions. And the reason that I'm teaching this section, not only for loan officer and for processors, because there's a lot of loan officers that self-process. They do all of this. That's how a lot of us start in the industry. Okay. So a lot of times you get and know that the front part of a real estate transaction is really intensive, right? They've got to deliver earnest money within the prescribed amount of days. I think typically it's 3, sometimes I've seen it 5 if there's a holiday, but within 3 days of signing, they got to get their earnest money to title. They got to get the inspection ordered. Like the first 3 days of going under, I want them to sign my disclosures. Like everybody wants from the borrower. So if I can help take this piece off by helping get a quote, then when I call them in 4 days and say, oh, hey, James, I just wanted to double check. Did you get that quote from your insurance company? And they're like, oh my gosh, no, we got caught up in the inspection. I say, that's okay. Hey, on Tuesday, I forward you an email from Brenda. She's a local mortgage or a local insurance broker that we often ask her to quote stuff. Go ahead and take a look at that. If you still want to have your car insurance provider quote that for you, that's fine. If you want to go with this policy from Brenda, her contact information is below and you can just give her a call. But can we get this information back by, tomorrow at noon? Or we're expecting to have the rest of your conditions back for the file to submit to the underwriting on Tuesday. Can you get this back to me by Monday night? Okay. You want to try and get these 5 things in as soon as possible so you can get the CD issued. Does that make sense? Okay. Any questions? Good. Okay. As an originator, I was taught to have different signatures for my email. If you're a self-processing originator, this will be the biggest time save. If you're a processor, this will be a huge time save. Okay. So I'm going to go over some standard things that will help you in requesting documents, what you should ask for from the get-go to help you get through this process faster. Okay, so I had 3 signature templates, well, 4, and then I merged one. So up to you if you want to have 4. Okay. So I have an email template from what I want to get from the borrower. After I talk to them, I've got their application. I am qualifying them based on our phone conversation, but I am not pre-approving them until I get these documents in. Okay, I'm going to qualify them based on our conversation, but I will not pre-approve them until I have these documents. So I need 30 days pay stub. And I always say most recent pay stub. Okay, 2 years W-2 or 1099. If you're self-employed, I need 2 years tax returns, personal, and business. And these are different. This is a 1040. This is normally going to be an 1120, 1120S, or even a K1. Okay, I need their ID. Some people might argue with me about this one, but I will explain to you why I do it this way. I only ask for 1 month of bank statement. In part because most of the time you're going to need another month. And on a purchase, you're going to need to show that they've written the earnest money, cleared their account, and all that other stuff. So chances are you're going to need more anyway. This is a discretionary call, okay? But I know that if I'm submitting this within 2 days of them going under contract, their earnest money check hasn't cleared yet anyway. So I know I'm going to have to come back and ask them for more banking documents. I'm going to see where the cards fall. If you want to ask for 2 months up front, go ahead. I'm just saying I don't do it that way. I don't do a lot of, what?
Do you specify that you need the most recent month?
Yes, thank you. Okay. Because a lot of times when you ask them for a bank statement, it'll be like today. They'll be like, oh, well, my bank statement doesn't come out until the 20th. Yeah, I know. I get the most recent. Yep. Yeah. Okay. Okay. Now, this is why I used to have 4 emails, because I would break this out between a purchase and a refi. So on a purchase, I also need the contract. I want a copy of their earnest money. And I just tell them, listen, before you go to title, just take a picture of it and send me a picture of it. Okay. I want their earnest money. On a refi, I want their mortgage, their current mortgage statement. I want any HOA statements. And this is one that you don't see very often. I ask for a utility bill. Here's why. If you're doing an FHA, sometimes you need a utility bill. If they have more than one property, they're looking at the utility bill to see and prove which one is their primary residence. So they call this like a luxury utility. They want like the cell phone bill or the cable bill, because people will try and scam occupancy because you get a better rate if it's owner occupied than if it's an investment or a rental. So we just, a lot of times we get in the habit of asking for this on certain deals. Okay, and that's why I used to have 2. I would do, like, if it was a purchase, I had 1 signature asking for these. If it was a refi, I'd have other ones asking for these. I also ask for their current insurance, provider info. Here, I I don't really do this anymore because I don't process my own files as much anymore. I have a dedicated processor now. But I might have asked them for the name of their car insurance company or provider. Okay, because I'm trying to shorten the curve to getting all of the bullet points that I need to issue a CD. Am I okay to erase this? Or does somebody need a second still? Am I good? You can't hear me? Am I good? Okay. Is Lisa getting ready to type in the? Oh, you want my big head, my head away so you can see that? Oh, damn it. Well, can you still see the board though? Okay. Everybody's okay if I erase this? Okay. Okay, if you are self-processing or you are a processor in here, you're gonna have another email signature for title. I'm giving you this information based on what we need in Colorado, New Mexico, and Texas. If you live in an escrow state or you live in a state or you do work in a state that has an attorney, you may need to add different things to your signature. So we're gonna ask for the commitment, the tax certificate. This is what's gonna tell us what the property taxes are. We're gonna ask for the closing protection letter. We need their wire instructions. The bank needs to know where they're gonna wire the money to complete the transaction. We're gonna ask for a preliminary CD. We wanna know what the prelim means before the final. Well, we wanna know what the fees are for this transaction. Okay, in New Mexico, we're gonna ask for the survey. Now, most title companies will order a payoff. Our processor order payoffs because I need to have more control of this. If I tell the borrower a loan amount that doesn't pay off their payoff, and now I got to increase the loan amount to pay off the payoff, like people get upset with that. So we order this right away. My processor orders this right away. When they send the title request for the title work out and they send the request for the insurance, she's also sending the request for the payoff at the same time, right? So I used the analogy the other day as like, when you send the file to underwriting, it's kind of like starting the washing machine before you go to wash the dish, or yeah, starting the washing machine before you go to wash the dishes. The washing machine doesn't need you to stand over it and make sure that the dial ticks, right? Just put it in, the soap in, close the door, pull the button, push the button, whatever, right? It does its thing. And then you go over here and you wash the dishes, right? So sending the file to underwriting is like starting the washing machine. Now we got to go over here and wash the dishes. We got to send all these other requests out. And hopefully what we're trying to do is get the dishes and the laundry done at the same time so the house is clean. Okay, we want all of this stuff to be coming back about the time we get the approval back. We've knocked off half of the conditions on the approval list, okay, so that we can turn that back in real quick and get this thing clear to close. When you send this request out, you need to make sure that you have your mortgagee. Oh. and the loan number. Okay. So application, credit, run AUS, price the loan, figure out what loan rate we're going to do at what bank. You or your processor, however you work with your processor, we're going to upload the 3.2 into the bank and get it registered so we can get a loan number. Now, I will tell you that a lot of banks have different mortgagee clauses. So a mortgagee clause identifies who the lending institution is. That's all a mortgagee clause is. Okay, it's who the bank is and the loan number. And they'll have different ones for insurance. Sometimes they have one for the commitment, one for the CPL, and then one for insurance. So you may be working with 3 different mortgagee clause. You just have, it's specific per lender. And you can, in their sites, you can Google it, just ask your account executive, like they'll point you in the right direction, okay? When you're requesting insurance, you want the policy deck page. You want the policy invoice. It's how they're going to determine what needs to be collected at closing, whether that's a purchase or a refi. Oh, it's right on my circle. Sorry, that says policy. And I would say more and more as a standard practice, you want the CRE, or the cost replacement estimator. Okay, what is this? What is this? Let's say you buy a house, or let's say that we're financing $300,000. Okay. Our insurance policy has the coverage of 210 plus extended coverage of 25%. If you don't know what I just said, that's exactly why I'm doing these trainings. I'm gonna share my desktop with you real quick. Okay. You will often hear extended coverage in regards to insurance discussed. So the policy has a coverage amount of 210. Okay, that's the policy is priced and written on a coverage of 210. They have extended coverage, which means if their costs go above and beyond 210 for any loss, they have an additional 25%. So you're going to take 210 times 1.25. So they have a policy that covers $262,500, okay, which is less than the loan amount we're doing. But the bank is like, oh crap, if that house burns to the ground, we're still on the hook for $38,000 here. Well, it used to be that you need to increase the insurance policy to cover our loan amount. And it was making people pay for more insurance than they needed to rebuild their homes. And now it's a version of Tidewater. You can't overinsure a property. So how does an insurance agent come up with these numbers? Well, it's the cost replacement estimator. And they're going to ask the client, what's the roof made out of? What's the flooring material? When was the roof replaced? How old is the electrical? When was the last time house was painted? Or, I mean, there's like 50 questions, okay? So if your insurance policy is less than the cost to rebuild, or the cost of the loan, sorry, the amount of the loan, you need this cost replacement estimator. We are seeing, I'm not sure if it's a guideline change, it might be, but we're seeing on pretty much every file that requests for the cost replacement estimator. So I just have my processors basically update this to say that they just request that from the get-go now. Okay. Real-time best practice. I talk to a client on the phone. I get their application. Okay, I verbally get the information. I send them the email with the request for documentation. Okay. I price the loan based on what they've told me their income is. I've pulled credit. Okay, so now I'm pricing the loan. So then I get an interest rate, and then I run my underwriting. Okay. Then I export that into a 3.2 file, depending on what, no matter what system I'm using in, or I'm manually entering this into the website. Okay, then I'm registering the loan. And then I'm disclosing. For me specifically, this is where my processor picks up. I've since received all the client documents from the borrower, and I send my processor an email. Jones is ready to submit. Okay. File goes to processing. Processor uploads or submits and sends out third-party requests, right? Title, insurance, and verifications of employment. You should have all of these back within 2 days. Verification of the employment is the only one that may be longer, especially with big corporations that don't use a third-party service like the Work Number or Employers Unity, a place where you can log in and export that data. Okay, sometimes bigger corporations have they tell you it takes 3 days. Fax your request in, it'll be 3 days. School districts, bigger restaurant chains, things like that, okay? And what you're trying to do between the originator and the processor, right, is while this is in underwriting, okay, it's up in here, we're gonna send all of these requests out, so that way it comes together at the same time that the loan is coming out of underwriting. So we're gonna have all of this stuff in the file, right? Now, if you are self-processing originator, one of the other things that you can tuck into the disclosing process is your letters of explanation for name, address, and inquiries. Man, you really want to clean up those approvals and reduce your touches on a file? Do this at the same time that you disclose your file. It'll take you an extra maybe 15 minutes, but you potentially are knocking off 3 conditions on your file from the get-go. Okay? So really, you get the approval back, and you've got most of this stuff in. You should be 24 to 48 hours from getting your approval back to getting it back in, depending on what additional you need from the client. And now you can see that that's why I recommend that as soon as you submit, right? Oh, sorry, let's put this in here, and the appraisal order. If we're on a 7-day turn time, and I put this in the day we go to underwriting, by the time we get out, we might be 3 days into our wait line. And if I'm waiting 2 days to get documents from the borrower, I should have my appraisal back in the next day or 2. In that day or 2, I should probably have my second updated approval And really what I want that last approval to have is just be waiting for the appraisal. So I can get that in, have the appraisal approved, issue the CD, and hopefully just be waiting for the closing date to arrive. But I will tell you that it doesn't happen like that very often, especially if you work with people with a little bit lower credit scores. Just their files just have more to them. That's all. It's not any different. They're just a lot more questions are going to be asked. Okay. Let me move out of the way so you guys can. Okay, if everybody wouldn't mind just taking themselves off mute. Great. Any questions on this stuff?
This was perfect.
Yep, it was great. This is amazing information.
Yeah.
So helpful.
Anything that you're still like, you know, I talk about this a lot, like I conceptually get the idea, right? Like I can wrap my brain around it, but like, how does it actually really work? Like, walk me through this section. Does anybody feel like that about any of the stuff we talked about today? No.
No.
Okay.
It's just a matter of, I think, re-listening to the video, like watching it again to kind of become more and more familiar with it. Every time we hear it, we catch other things.
Sure. The more you do this process after hearing some of this, you're going to start connecting more of the dots.
Yes.
Okay. You won't, hopefully, you're not hearing this stuff for the first time. Or normally what happens if you're coming back into the industry or you're newer is you don't know that you need a CPL until it's on your approval. Right. Or what needs to be on it.
And Jackie, when you say ordering appraisal, ordering title, ordering all these things, I feel like this is such a dumb question, but what do you mean? Like you're going into Calyx and pushing a button that orders it? Are you filling it?
Great question. Okay. I'm going to jump into screen share real quick. Okay, if you work inside Calyx, what you can, on the left-hand panel here, you're going to look for two forms, request for title, okay, and request for oopsies. And there's one here for request for insurance, okay? So you're going to put the loan number in. And I don't know if you know this, but when you're in Calyx, you actually can, you guys, okay. Think of these like emojis, okay? Like 1980s Nintendo, no, Atari emojis, okay? So this is a calculator. This is what's called a Cardex. When your parents worked in an office, they actually, instead of having like business cards, there was like this little Rolodex thing they used to keep on their desk with everybody's contact information in it. Yeah, that's what this is, okay? You can start storing.
I had one of those. It was in my parents.
I had one of those. It wasn't my parents either. That's why I'm like, oh God. Because half the people in here, right? Half the people in here, it was their parents. Okay. So you can actually store different lenders' mortgagee clauses in here. Okay. So I'm going to go in here and let's say this loan is going to Universal. So I'm going to select Universal. It's going to pop now I got to fix this on mine, but you're going to put the mortgagee in here. Okay. We've got the loan number in here. We have this pre-programmed into our Calyx. It's old. You can see it still says HUD. So whatever notes you want from them, right? So we want the title policy. So here's what we really do. We want the commitment, CPL. Oh, good Lord. CPL, wire, prelim, CD. We want the tax cert. Am I missing something?
Survey payoff.
Oh yeah, survey, depending on what it is, survey.
We order payoffs. Earnest money receipt. Usually we get that title's copy of earnest money.
Sometimes, yeah, sometimes the lenders want the earnest money receipt from the title company, not just the borrowers. Is there a chat message? Can somebody check that for me, please?
There is. Shoot. Monica asks, is this for a refinance?
What I'm asking for? Most of these are pretty standard. Payoff would be for a refinance. Earnest money would be for a purchase. Okay, and then you print, here's how we do it. We print this form. Oh, sorry, we print the form. We call it an RFT, request for title, or an RFI. Okay, so it has the borrower's name, their address, home phone number, email address, their social. So you gotta be careful with this, and their date of birth. It tells the title company that it's a primary residence purchase, tells them what property address, tells them the mortgage company or the bank and the loan number. Okay, it tells them right here what we're looking for is in regards to documents. Now, if it's a purchase, your contract will tell you who the title company is because it's picked by the seller, which really it's picked by the listing agent. Okay, so it might tell you, depending on, like, different state contracts are different. Like in Colorado, it tells us just the name of the company. In New Mexico, it tells us the actual person and the name of the company. So what our processors do is they pull up the contract, they look at the name of the company, the city that the property is in, and they just Google like land title, Commerce City. Okay, they call the office and they say, hey, I'm working on a purchase transaction for 123 Main Street. Can you tell me who my closer is? And that person will say, oh yeah, it's Kim Anderson. And she'll say, great, could I get Kim's email, please? Okay, then the processor will put together an email to Kim and say, hey, Kim, my name's Isabel. I'm the processor working on this file for 123 Main Street. In the subject line, we tell them, hey, it's a request for title work on a purchase, however you want to do it. Please see the attached request for title work. Okay, and we do the same thing for insurance. So, whoops.
Laura, if you like, I have these emails already made up. I can send you what mine look like for time. I send like basic message to all those guys.
Yeah, I would appreciate that so much.
Yeah, of course.
Yeah.
That would help so much. Thank you so much. Yes.
Yeah. And then here's the
I'd love that too.
Here's the
Oh,
same
definitely.
insurance. Oops, sorry. Looking over you guys, sorry. Okay, so same thing for insurance. You can type this in, but really if you have access to Calyx, you can also create this same form in an Excel spreadsheet with something that I offered to give to the processing class, where you do like different tabs, and maybe tab A is the blank page that generates the form. And tab B is where you keep all of the different lender mortgagees, right? So you just go in every time you have a new client and you just update the information for that specific client. I would say if you're independent processing and you don't have access to Calyx and you want to do that, I'd probably use the spreadsheet. Do we have another chat message that I need to know?
Oh, I'm just asking everybody who wants my emails to say me so I can send them to them.
Okay. And then you would then print this form and you save it as a request for insurance or an RFI in the borrower folder, RFI. We're starting to get in the habit where we say like RFI and then the name of the employer. So like, this is for the taco house, because if they have more than 2 employers during the most recent 2-year period, and we need, oh, Jesus, take the wheel. This is insurance. I was thinking about showing you about verifications of employment. So just scratch that for 1 second. Okay, so we save that. Now, Verification of employments are the same thing. You're just going to go up here to verifs. So you can do verification of employment or verification of mortgage or rent. You'll probably on occasion, if the borrower can't provide canceled checks, you're going to have to go to their landlord or apartment management company to ask them to verify their rental history. But for verification of employment, you're just going to go to verification. This is your processor's name. It just tabbed through, it automatically puts the date in. Now we wanted to insert the employer from the loan application. And we always want this to come from either human resources or payroll. You typically do not ever want to put a name in here. Even if you call the taco house and you say, hey, I'm trying to do a verification of employment for Jamie, who would be the person that would verify verification of employment? They'll be like, oh yeah, I can tell you. You'll say, oh, that's great, thank you so much. I actually have a form that I need to send. If you don't mind, can I email it or fax it to you? And what's your title with the company? Okay, don't send it to their name because it's not considered organic. And how do you know if you send it to Debbie, that Debbie isn't Jamie's prep cook and they're committing fraud? Okay, you need to know if Debbie's the office manager or she does payroll or accounts receivable, accounts payable, whatever their job title is, put the job title there, but never put their name. Okay. And then you're gonna print this form. So we're gonna print lender. And we're just going to save it in Jamie's folder, VOE for the taco house. Now, I normally save it when it's unsigned. I normally save it as US for unsigned. And then when it comes back, I take the unsigned off. Otherwise, your files will start to get really messy. Okay, so VOE. Oh. Now, if you're doing these yourself, if you're self-processing or you have a processor, there's a couple things that you're going to get dinged on if they're not complete. You or your processor need to sign this box here. It'll get sent back to you. It's the most annoying, stupid thing in the entire world. Make sure it says see attachment. So it's a box right here in Calyx that says see attachment, because you're going to send them the verification of employment with the borrower's signed authorization that they completed in their disclosure package. No lender should be sending this, or no employer should be sending this back to you without the signed permission sheet. Okay. You want to make sure their hire date, what their current position. Most states will not comment on box 11, and that's okay. If it comes back with no comment, please just have them put no comment. Because states that are employment by will, it is considered a guarantee or a contract of employment if they fill that out, okay? You need, a lot of places miss this right here. They just mark a box, annual, monthly, weekly, but they don't tell us how much annual, monthly, or weekly. So this is one. Then you have to do however long they've been there. So sometimes what you'll see is Jamie's been working there since 2016, but they only do this year's data. They got to do all the information for how long they've been working there. And a lot of times this gets missed. Okay, this is their year-to-date income through when? Through when? Okay. We do want as much of this side filled out as possible. And any remarks, sometimes this might, you'll know, I wouldn't be too worried about this until you're a little bit more experienced on asking for any remarks. Usually if I need something on a verification of employment, like I need something specifically addressed, I let the processor know, hey, please ask the employer to comment on XYZ thing about their employment in the remarks section on the verification of employment. Now, the other thing that you will get is this part right here, part 3, is if you need to verify previous employment. So like if you're doing an FHA deal and they've been with this employer for 15 months and you got to get the previous employer, sometimes they'll fill this out. Depends on the underwriter or the bank. they'll let you slide with that, but really you just want them to complete part 3. So if you're sending this out, right, you've called the employer, you've got the contact information, you just want to put on there, this is for a previous employer, please only or employee, please only complete section 3. Okay, but make sure that they give the salary or wage at the time of termination. And then they sign and complete it down at the bottom. So you just generate these forms, and when you request it, you just send it out. Now, if this was the most challenging thing as a processor, is if the employer uses a third-party verification source, the big one is going to be the work number through Equifax. If your loan officer or you as a loan officer do not have an Equifax account, you probably want to consider signing up with a credit reporting agency that will let you order this through them. Because if you don't, it's a real pain in the ass, because the borrower or the employee now has to generate a salary key, and it's like, it really is a challenging process, and it is such a time suck. So if you can bypass getting verification of employment from the work number by not having to use a salary key, you need to do that. And there are a couple ways of doing that. You can do it through the credit provider. So Advantage Credit is super easy. Your loan originator can go through, or you can as a loan originator go through the process of getting a direct Equifax account, and they're going to come and do a site inspection the same way that your credit agency does. If you work for a larger brokerage, that may not even be an option. The work number also allows the borrower to create an account and go in and go get their own previous employment history. Unless they are a significantly tech savvy person, right? Like if you have someone that's just real not, like they're already having issues signing disclosures electronically, I would not have them do this. But a borrower or an employee can go to the work number themselves, create an account, and get their past employment history. Okay. There's another one called Employers Unity and I-Verify, I think, are the other two. Do not do TrueWorks. Do not, let me repeat, do not do TrueWorks. It is a service where they will go out and get the employment verification for you. And we learned this the hard way. They charged us $99, so we got a work number verification back that cost $39. So they made $60 to go and get a verification of employment from the work number. Okay, so don't, make sure that if you're trying to Google, you know, employment verification for a specific company, make sure you're looking at the Google search options and they're not an advertisement. Okay. All right. Any other questions? We're running just
best practice for me, what I do is I just call the employer and they'll tell you if they use the work number, and they'll even give you their code if that's the case. That's always, I always just call. I call whoever it is and they will tell me, oh no, we use work number, here's our code. There you go. For anybody who is watching the YouTube, if you would also like my email signatures, I will have Jackie link my email below. Just send me an email requesting those email signatures.
Is it, are we on live YouTube? Because I thought it said it didn't connect.
When you post it.
Oh, when I post it, right. Great. Got it. Okay. Any other questions? And that's, Laura, I'm so glad that you asked. That is what I call like ego afraid. Those were the types of questions where like, I didn't want to ask because A, I felt like it was something that I should know. And B, I don't want anybody to frown upon my ability to do the job because I had this question that seemed like I should know how it is. Exactly. Especially if you're coming out of retail. So I always say, like, when you work in retail, you have a wipe your ass department for everything. You don't have to do all of this. You literally click a button and somebody else does it. Yeah. And then it just comes back, right? It like goes off into solar la la land. Somebody, like the man behind the screen, does the things. And then I get an email that says your document is in. So for me, it was like I had done millions of dollars of loans, millions, tens of millions of dollars in loans, and I didn't know what EOI was. I mean, like, I did not feel very confident, right? And that's when I really started to say to myself, like, you know what you're doing. You've done tens of millions of dollars of loans. This is just a different bite. You know, it reminded me of like, I learned how to drive in an automatic, right? But the first car I bought out of high school was a manual, right? It's not that I didn't know how to drive a car. I just didn't know how to drive a manual car. I knew how to drive a car. I'd been driving for 2.5 years.
Right.
So it's the same thing, right? Like, you know, you know some of this stuff, but like, and then if you go and work, like, if you're a third-party processor and you're working for this lender or this loan officer over here and then this loan officer over here, right? Because when I was a third-party processor, I was doing 32 loans a month for 2 different companies or between 2 different companies. Okay, so how I processed loans at one company was entirely different than how I processed them at the other company. But getting a loan from application to close is still the same, like the same information has to be verified.
Right.
The same things have to be underwritten, the same qualifications of the borrower still have to be done. But how I, like, right, what you're saying, how I request these things is different. And when I came from Wells Fargo, I literally just pushed a button after I entered the insurance information. I literally just pushed a button. I have no freaking idea what happened after that. None. Other than on the rare occasion I had to call the insurance department and be like, where's my insurance? I ordered it like 3 days ago. Why don't I have it?
Yeah.
Okay.
Thank you.
Okay, you're welcome. Any other questions? Okay. I would just real quick, if you are an originator and you are originating an FHA loan, you got to get your verification of employment. I would say it's just as critical as your pay stubs and W-2 to have a verification of employment. And I would not issue an approval to a buyer or a refinance without having your verification of employment first. I just wouldn't. I will tell you that I've had too many come back and bite me in the ass afterwards because their year-to-date doesn't equal the average number of hours that they work, or you qualify them on 40, but really they only work 38.7. And I've literally had deals like unravel, and we've had to try and like lace them back up because I qualified them on 40 and they only work 38.7. So to calculate that, if you're making 20 bucks an hour and you're actually an hour and a half short, that's 30 bucks an hour a week. That's $120 a month. Times 10 months, that's $1,200 a year that I thought you made that you didn't make that I just qualified you on. Right? So you might think an hour and a half isn't a big deal. It's $1,200 a year. Okay? So I would just say on an FHA deal, if you're going to get in the good practice of doing things now, just basically tell yourself as you're waiting for the borrower to send you those other documents, the pay stubs, the W-2s, and all that stuff, get that VOE ordered. That may mean that you have to send them a borrower's authorization to sign before you send out the initial disclosure package. And that's fine. And that can be generated in Calyx. It's on that left-hand screen as well. Okay? Okay. Well, thanks, you guys. Thanks for hanging tight with us. We'll have this scrubbed and edited and hopefully posted by tomorrow so you can listen to it. We've got about